Good afternoon, everybody. It's Scott Gillum with the Shadow Trader short video. Today, I want to look at Nike. As you can see from the chart, Nike has been kind of consolidating with a big drop-off that happened March through the April timeframe as we came into this administration's tariff situation. A little bit of reprieve as we went into July, and then we had earnings that came out at the end of June, 1st of July, and lo and behold, Nike fooled almost everybody with a professional gap up to around that 69 and a half to 70 level. And now we've taken the push to the upside, overbought, a little too expensive, and we're starting to retrace. So what's the setup here with Nike that still has this huge consolidation range back from July of last year through August, then from November all the way through March of 2024-25? Well, it looks like consolidation is here once again, as well as we still have the uncertainty of what type of tariff Nike has to pay for their shoes being made in Southeast Asia. So what's the trade setup? Well, it's stagnant. What's the best trade for a stagnant trade? Sell credit above, sell credit below in an area that is conducive to the credit. Let's take a look. Going out, well, let's get back to the table first. I want to go out a couple of weeks, July the 25th. That reasoning is because the next week, which is August the 1st, we start to see these tariffs taking effect and having some sort of impact on companies and traders who are buying those companies that are going to be paying those excessive tariffs. So let's do the 25th of July, the week before, and take a look. We've got one standard deviation to the downside, goes to 70, one standard deviation to the upside, 78, or about $3 movement up or down. At the current price of around 74, that runs exactly what a straddle would cost you. $1.70, $1.70, 350. That's about where I want to be involved here and not get anything excessive. So the trade, selling credit below, sell the 71 strike, go $3 away, buy the 68 to cap off my $3 of risk. On the upside, sell the 77 strike, buy the 80, again, $3 wide, capping off my risk. For this, I don't like this number of around 79. I'd like to be doing something in the 85 level. And why do I say that? Well, if I take a look at an 85 credit and I have $215 worth of risk, I now get about a 40% return on my risk capital in the next 16 days. So I have currently pending with our subscribers a 70-67 put vertical or bull put against the 77-80 bear call sitting, and I'm going to adjust that to that 71.68 level for this video and for my subscribers tomorrow if we get no fill on today's order. Let's take a look at what the probabilities of success here. As you can see, I make profit as long as we stay above, what's my break even on the downside? $70.17. On the upside, $77.82. If I stay within this area, I make all my credit. We've got flat delta. We've got good theta. on a price action of around $85 worth of credit on a 215 net debit for the trade. So there you have it. Nike. Play in between. Play the pause. Play the pit stop. Out to 25 July. Thank you much. Hi there. This is Scott Gillum from the Stock and Options Room of Live Trading Suite. If you enjoyed this video, please hit the like and subscribe buttons down below. And if you'd like to trade live with me in real time, click again that link in the description below. Good trading to you all, and I'll see you in the room.